Hello, you're welcome again. Now, I want to talk about risk management and psychology. You can see that I did not put demand or supply there. This can be applied to any type of trading. If you are trading demand, trading supply, trading any type of strategy, you can apply this strategy and you can apply this risk management and psychology on it. Now, let's talk about risk management and psychology. Now, first thing first, with respect to the type of trading we will be doing, that's demand and supply. We are talking about top-down analysis, whereby we find demand or supply zone from the monthly to the weekly to the daily to the 4 hour or probably 1 hour. Then we trade accordingly. Now, by the time that our monthly, weekly, daily, 4 hour and 1 hour align, maybe the market is selling from the monthly, then we spot a selling signal from the weekly, spotting selling signal on the daily, selling signal on the 4 hour or 1 hour. You can see that there's a very high chance, like 90% chance of that trade playing out. Okay, so this particular video is going to be a bit long. Please bear with me and follow accordingly. Now, there's one thing that somebody said, that's Ben Skopinski. He also said that if you have 1%, let's say you have $1 million, $1 million, okay? Let me write it very well. If you have $1 million and you are making 1% of $1 million every month for 12 months, okay? And we know that 1% of $1 million is what? That should be 1% of $1 million, that should be $10,000, okay? So you are making $10,000 every month for 12 months. That is going to be 10 times 12, and by the time you do the mathematics, 10 times 12, that's $120,000 for a whole year, and that will give you a 12% gain, 12% on $1 million. But one problem with we traders is that we don't have much capital, and as such, first thing first, we may not have the patience to wait for price to get to monthly time frame to get to our demand or supply. We may not also have the patience to wait for weekly. We may not have the patience to wait for daily. Most people trade from the 4 hour, 1 hour, 15 minutes, and so on and so forth. They may not want to be a swing trader, but in the long run, swing trading is the best that I've been seeing. Okay, now let's look at it. Capital management. We have understood the reason why we are using major time frame of top-down analysis, because the probability of trade playing out there is very high compared to the lower time frames. Now, capital management simply means amount to use per trade. How much are you going to use to trade? Like 0.1 or 1% upward of capital is what is recommended. All right. If you are using your personal account or Profem account, I will explain that. All right. So, for example, let's say you are as we recommended. Let's say you want to use like risk to reward ratio, meaning that you risk $1 to get $1, or you risk $1 to get $2, you risk $1 to get $3. That is the risk to reward ratio. Now let's look at it that maybe you have $1,000 as your capital. Now if you are risking 0.5% of the capital per trade, that is to say you are going to divide the 0.5 by 100, and that is going to give us 0.005. Just some simple mathematics here to know how many trades is available with 0.5% of capital, meaning that how many trade can you take before your $1,000 will either go to waste or it's going to make you more money. Well, how we are going to do that? We are going to multiply the 0.5%, this value here, with the $1,000 capital that we have hypothetically. Now, by the time you do the mathematics, 0.5% is 0.005 times the $1,000. That is going to be $5. And by the time you multiply 5 times 200, how do I get that 200? When you divide 1,000, okay, by 5, you are going to have 200. So, meaning that 5 times 200 is $1,000. This 200 signifies that this means it will take a total of 200 trades when risking 0.5% of capital which is the $1,000 now, to run down the account. And we know, bringing psychology into this, if you have $1,000 and you take the first trade $5, it did not go your way, you still have $995 to go round. That will give you more confidence to take the trade. But assuming maybe your first trade is 10% and you lose the first trade, and 10% of $1,000 is $100. By the time you now lose one trade, you now have $900. You lose another one, you have 800. You see that if you are not confident enough, your confidence will come down. You may not be able to continue the trade. All right, so it is more better to go with the percentage you can bear with the loss that you can bear. All right, so let's assume the same thing using the same metrics as above for 1%. If you are using 1% of your capital, and 1% of capital is 0.01 of capital, just do the mathematics. 0.01 times 1,000, you have $10, and 10 times 100 equals to $1,000. This means it will take a total of 100 trade when using 1% of capital to run down the account. All right, so let's look at, what if you are using 3% for your trading? The same formula, 3%, that's 0.03, multiply with the 1,000, we now have $30. And by the time you do some rough calculations, this means it will take a total of 22 trade when risking just 3% of your capital to run down the account. Now let's look at the final one. What if you are using 10% of your account? Do the mathematics, the same process. 10 divided by 100, that's 0.1. Multiply with the capital, 0.1 times 1,000, we have $100. And by the time you do the mathematics also, that's 1,000 divided by 100. You'll see that we have 100. So sorry, you see that we have 10. That is to say, if you now have $100 we are using per trade, how many $100 can we get in 1,000? That is 10. So that is to say 100 times 10 is going to give us the $1,000 back. All right, so therefore this means it will take a total of 10 trade when risking 10% of capital to run down the account. That's if the full 10 trade did not go to your favor, you would have lost $1,000. Okay, that is just if you are risking 10%. So it's up to every person to know which one they can bear and which one is it's manageable for them. Now let's look at personal versus pro firm account. We have all those proprietary firm whereby you can buy accounts with $100, you can buy $10,000 accounts, and so on and so forth. Now for the personal account, you know that all the capital is your own. All the capital account balance can be used to trade because you are the one that have it. So if you have $1,000 in your account, you can use the whole $1,000 to trade without any restrictions. You are the one that can dictate the rules by yourself. So let's assume you have $1,000 and you want to use 1%. That is to say, you now have $1,000 and 1% you'll be using is just $10 per trade. And with that, you can have a whole 100 trade to go round. But if you are using a pro firm account, please take note of this difference, because many people mistake it, and before you see it, they lose account a lot, probably because they do not firmly understand the process. Let's say the overall drawdown is the main capital to use. All right, let's say you have a pro firm account of $10,000. So people will think that, okay, maybe you use $100 to buy a pro firm account of $10,000. For example, you see in your account balance $10,000. But first thing first, always take note that it is the overall drawdown that is your own capital that you cannot use on the total capital of $10,000 when you are using pro firm. Hope you understand. So what you should take note of, every pro firm they have rules. Most pro firm they tell you that your overall drawdown is 10%. And what that is saying is that means from the total capital of $10,000 that you have, you can only use $1,000, because if you lose a total trade that is going to be equal to $1,000, you will lose that account, meaning that your $100 that you have used to buy this trade is gone. Then you cannot use that your money is gone and your account is also gone. So if you want to use 1%, like you use on your personal account, try to understand. If you use 1% to your personal $1,000, you have 100 trade. But if you use 1% of the $10,000 you have for profit, you see, it is going to be $100, yes, that should have, and that would have given you 100 trade. But where the catch is now that since the overall drawdown is your main money and the overall drawdown is 10%, simple mathematics letting us to know that 10% of $10,000 is just $1,000. So it's like you have now fall back to your personal account balance, whereby if you use 1% of $10,000, it should be $100. But with this $100, you only have 10 trade. Alright, that's if you are using $10,000. But if you are using your personal $1,000, you only have 100 trade. So for you to, if you want the two to be balanced, or no, it's not even necessary. I hope you understand it now. So put it at the back of your mind that the $10,000 is just $1,000 you can use, and as such, if you are using 1% of the $1,000, you now have only, no, if you are using 1% of the $10,000, you only have 10 trade, because automatically 1% of 10,000 is $100. So 100 times 10, you now have 1,000. Automatically, it is only 1,000 you can use. You cannot use the complete $10,000. I hope that is simple to understand. So it is best to at least have 20 trade samples in any account balance. What that means is that if you have at least, not that you just have only 10 trade. If you have 10 trade in your account, if you have only 10 trade to use, you may be discouraged if you have lost 5, 6, 7, all those things. But if you have 20 trade, at least you may be encouraged. So therefore, you can use 0.5% when you are using profit instead of 1%. Because if you use 1% or any profit, you only have 10 trade. But if you use, especially when the overall drawdown is 10%, I hope you understand. But if you use 0.5% of the capital you are given from the profit, you can now have 20 trade. So to have 20 trade samples with any profit that has 10% overall drawdown, always take note of the overall drawdown. That is your main money. Risk 0.5% of the total capital. Okay, if you use 0.5%, meaning that you have a total of 20 trade to play around with before you can either pass the account or fail the account. But if you know your strategy is very strong, like probably these are top-down analysis, just trading demand and supply and trying to put everything together, you can use 1% of your capital, knowing that you have only 10 trade when you are trading profit. Alright, but if you are trading your personal account, you have a whole of 100 trade. So if you have $10,000 in your personal account and you are trading 1%, you can trade with $100 per account, knowing that you have a whole 100 trade. So if you lose 5, 10, 20, it doesn't affect you much. You still have a lot of money to trade with. Well, I hope this is very understanding. Alright, thank you very much. Please watch it over and over again. You will try to understand my explanation. Thank you.